All right, so today we're going to dive into something that I'm sure is going to be super relevant to a lot of you out there,
Mm-hmm.
and that's income from house property in India,
Yes.
specifically how it's taxed.
Yeah.
We've got this great excerpt from bankbazaar.com, and it's packed with info.
It really is.
So get ready for some serious insights.
I think this is a topic that a lot of people kind of feel like they're navigating a maze
Yeah,
when they're trying to understand this, but it really doesn't have to be that way.
right.
Once we break it down, you'll see how important it is for making smart financial decisions, especially if you own property
Yes.
or are thinking about buying some in India.
Okay, so first things first.
Okay.
What exactly is house property according to the Indian tax laws?
Yeah.
Is it just the building itself?
That's where it gets interesting.
Okay.
It's not just the structure.
Okay.
So according to the source here, it includes the building and the land that comes with it,
Oh.
like gardens, parking areas, the whole shebang.
Yeah.
And here's why that matters.
Yeah.
It directly impacts how the value of your property is assessed
Right.
for taxes.
Okay.
So the bigger the package,
Yeah.
the higher the potential tax hit.
That makes sense.
Yeah.
Now, I noticed in the source material, they mention a whole bunch of terms that might not be familiar to everyone. Things like annual value,
Yeah.
municipal value, fair rental value,
Right.
even standard rent.
Yeah.
Can we just decode those real quick for our listeners?
Absolutely. So annual value is essentially how much you could theoretically rent out your property for each year.
Gotcha.
And then you have municipal value, which is what your local municipality says it's worth. Think property taxes.
Yeah.
And then there's fair rental value.
Okay.
This is what similar properties in similar locations are actually renting for in the market.
So it's like comparing apples to apples in the rental world.
Exactly.
Okay. Got it.
Yep.
What about standard rent?
Yeah, standard rent comes into play when the Rent Control Act is in effect. So this act sets a cap on how much rent owners can charge, which is designed to protect tenants from unfair rent hikes or evictions.
So it's a balancing act between the rights of the owners and the renters.
Exactly.
Got it.
Yeah.
And then last but not least,
Yeah.
actual rent received.
Yes. That one's pretty straightforward.
Right.
It's just the cold, hard cash you're collecting from your tenant every month.
Yeah.
No estimations.
Well, hypotheticals.
Yeah, hypotheticals there.
Okay.
Straight up.
All right. So now we've got our vocabulary down.
Yes.
Let's connect this to taxes.
Okay.
The source material mentions something called gross annual value, or GAV.
Yes.
What is that all about?
So GAV is like the foundation for figuring out how much income tax you'll owe on your house property.
Gotcha.
It's the first number we need to work with.
Okay.
To determine GAV, you have to consider a few different situations. Like if your property is rented out, your GAV is usually the total rent you receive for the year. But if it's not rented, then you have to look at the fair market value or the municipal valuation, whichever is higher.
So even if you're living in your own place,
Exactly.
not earning any rent,
Yeah.
you could still have a GAV based on what it could be rented for.
Right.
Or what the city thinks it's worth.
Yes, exactly.
That's interesting.
And if the Rent Control Act applies, things get even more complex.
Okay.
In those cases, the GAV is calculated based on the highest of three values.
Okay.
You've got the standard rent set by the Act, the actual rent you receive, if it's higher than the standard rent,
Okay.
or something called the net annual value,
Okay.
which we'll get to in a bit.
Okay. So multiple factors at play here.
Yes.
Makes sense now.
Yeah.
Once you have that GAV number,
Yes.
how do you actually calculate the income that will be taxed? This is where things, I feel like, can get confusing for people.
You're right.
Right.
There's another layer to it.
Yeah.
Enter the net annual value, or NAV.
Okay.
To get to your NAV, you subtract any municipal taxes you paid on the property from your GAV.
So essentially, you're deducting those property taxes
Exactly.
before calculating your final taxable income.
Yes.
Okay, so it's like getting a little credit for those city taxes.
There's a little cushion that
we all love.
Yeah,
that.
exactly.
Like that.
And then come the deductions.
Yes.
Section 24 of the Income Tax Act is your friend here.
Right.
It lays out two major deductions you need to know about.
Okay.
First up is a flat 30% deduction on your NAV.
Wow.
This covers things like repairs, maintenance, even collecting rent, regardless of your actual expenses.
That's huge.
Yes, huge help.
But keep in mind, you don't get this if your annual value is nil.
Okay.
More on that later.
Okay, so a little cushion to help offset those inevitable property costs.
Exactly.
Love it.
Yes.
What about that second deduction?
So this one is all about the interest you paid on any loan you took out
Okay.
to buy or build the property.
Right.
Here's where things can get tricky.
The amount you can deduct hinges on when you got the loan.
Okay.
and whether construction was finished within 3 years.
Oh, so timing plays a role.
Timing is everything.
Can you quickly break down those scenarios for us?
Yes. So if construction wrapped up within 3 years of taking out the loan on or after April 1st, 1999, you can deduct the lesser of either RS 1,050,000 or the actual interest you paid.
Okay.
For any other scenario, the limit is RS 30,000 or the actual interest paid, whichever is lower.
All right, so there's a cap on how much interest you can deduct depending on your circumstances.
Exactly.
Still super helpful deduction.
Oh, yeah, definitely.
To keep in mind.
Definitely.
And after you factor in both of those deductions, the 30% statutory one and the interest deduction,
yes,
you finally arrive at your taxable income from the house property.
Exactly.
Yee, it's quite a journey.
It is a journey.
From GAV to that final number.
It is.
Okay, here's a question I'm sure is on our listeners' minds. Who exactly is responsible for paying this tax?
Yeah.
Is it always the person whose name is on the property deed?
Not necessarily.
Okay.
So the source material makes a distinction between the owner and the deemed owner.
Okay.
Legally, the owner is whoever's name is on that deed. But when it comes to taxes, the deemed owner is the person actually benefiting financially from the property.
I see.
They use this great example of a guy named Mr. Babu who owns a house in Bangalore, but he's had to relocate to Pune for work.
So even though he owns that Bangalore house, he's renting in Pune.
Exactly.
Which means no rental income from the Bangalore property.
Right. Yeah. That's where the deemed owner concept comes in.
Okay.
So even though Mr. Babu is technically the owner, he's not the one reaping the financial rewards from that house.
So in this case, he might not be liable for the tax on that Bangalore property.
Correct.
Even though his name is on the deed.
That's right. It boils down to who's actually receiving the financial benefits.
Interesting.
This distinction is super important because it means the tax burden falls on whoever's profiting from the property.
Right.
Even if they're not the registered owner.
Okay, so it's not just about ownership on paper.
No.
It's about who's actually getting the money.
It's all about the money.
Okay, now the source also has this step-by-step numerical example.
Yes.
I'm thinking it might be helpful for our listeners to hear us kind of walk through it.
I agree. It's really helpful to see it play out with real numbers.
Yeah, what do you think?
Let's do it.
All right, so let's imagine you're renting out a property for, say, $15,000 per month.
Okay, so your total annual rental income would be RS 1,080,000, which is RS 15,000 times 12 month. This becomes your GAV for this particular scenario.
Okay. Yeah. Now let's say you paid RS 10,000 in municipal taxes on the property this year.
Okay, to calculate your NAV, you would subtract those municipal taxes from your total rental income.
All right.
So RS 1,080,000 minus ARV 10,000.
Yeah.
Leaving us with a NAV of RS 1,070,000.
Gotcha. Next comes those deductions.
Yes.
First, we have that 30% statutory deduction on the NAV.
Right. 30% of ours. 1,070,000 comes out to ours, 51,000. That amount is deducted from your NAV.
Which leaves us with?
Ours, 1,019,000.
Aye.
Which is our 1,070,000 minus ours, 51,000.
Gotcha.
Yeah.
And let's say you also paid ours 50,000 in interest on the loan for this property.
Okay. In this case, you can deduct the full ours, 50,000.
Okay.
Because it's less than the maximum allowed for interest deduction.
Awesome.
Yep.
So to figure out your final taxable income from this property, we subtract that interest deduction from the amount we had after the statutory deduction.
Correct.
So ours 1,019,000 minus ours 50,000
equals ours 69,000.
Boom. Ours 69,000.
There it is.
Is the income from this house property that would be added to your total income when it's time to calculate your taxes.
So that was super helpful to see how all those pieces fit together.
It is.
Now, the source material brings up something called zero annual value.
Which sounds almost too good to be true.
It does.
Can a property really have no annual value for tax purposes?
Believe it or not, it can.
Really?
There are a few situations where the annual value of your property is considered nil.
Okay.
The most common scenario is a self-occupied property, or SOP.
Okay.
This means the owner is living there and not renting it out for income.
Wait a minute.
Yeah.
Are you telling me that if I live in my own house,
yes,
I might not have to pay any tax on that potential rental income?
You got it.
What?
As long as you're genuinely living in the property and not collecting any rent from it,
okay,
the annual value is considered zero.
And what about our friend Mr. Babu?
Yes.
His situation's a zero annual value case too, right?
Absolutely, because Mr. Babu has to rent a place in Pune for work.
Right.
His Bangalore property sits vacant.
Right.
He's not generating any income from it.
Yeah.
So in his case,
Yeah.
the annual value of his Bangalore property would also be considered nil.
So even though he's the owner,
Yep.
the fact that he's not living there
Right.
or renting it out
Exactly.
means he might not have to pay tax on that potential rental income.
You got it.
That's a pretty big deal.
It is a pretty big deal.
Yeah.
But here's an important point.
Okay.
Even though the annual value is considered nil in these cases,
Mm-hmm.
Mr. Babu would still be able to claim a tax deduction
Okay.
for the interest he's paying on his home loan
Oh.
for the Bangalore property.
Okay, so even with zero annual value,
Yes.
there could still be tax benefits.
Absolutely.
I love it.
Yes, it's there.
The source also mentioned some tax saving strategies for income from house property.
Yes.
Can you give us a sneak peek at some of those?
You bet there are some seriously clever ways to minimize your tax burden when it comes to a house property.
Okay.
Did you know, for example, that taking out a joint home loan with your spouse or co-owner can actually double your tax deductions
Oh, wow.
on the interest?
Hold on. You're telling me I can potentially cut my tax liability in half
Yes.
by having a joint loan with my spouse?
Exactly. It's a really powerful strategy, especially if one spouse falls into a higher tax bracket than the other.
Yeah.
So by splitting that interest deduction, you can save significant amount of money.
That's a game changer.
It is a game changer.
All right, what other tax-saving gems are hiding in this source material?
Well, if you're thinking about buying a second home,
Yeah.
consider carefully who owns it on paper.
Okay.
Putting the property in your spouse's name
Okay.
or a relative's name could help you avoid those higher tax brackets altogether.
Interesting.
And speaking of ownership,
Yeah.
joint ownership is another powerful tool.
Okay.
By dividing the ownership of a property, you can potentially split the tax liability as well.
Those are brilliant tips for anyone thinking about investing in multiple properties.
Yes.
Any other strategies our listeners should know about?
Absolutely. Think strategically about which property you designate as your self-occupied property or SOP. Especially if you own more than one,
Right.
you can only have one SOP.
Right.
And it's exempt from tax on any rental income. So if you want to maximize your savings, choose the property with the highest potential tax liability as your SOP.
That's clever.
It is.
Any final words of wisdom for our listener on how to minimize those taxes on house property income?
Don't let those empty properties gather dust.
Okay.
If you have a property you're not using, renting it out can generate income and potentially offset your tax liability.
Okay.
Remember, you'll be taxed on the fair rental value even if the property is vacant.
Right.
So putting it to good use is a win-win.
Such great advice.
Thank you.
It sounds like there are definitely ways to optimize your tax situation when it comes to house property.
For sure.
If you plan ahead
Yes.
and make smart choices.
Absolutely.
You got it.
It's all about being informed and proactive.
Love it.
And remember, tax laws are always changing, so it's a good idea to stay updated.
Yeah.
You know, maybe even consult with a tax professional to make sure you're making the best choices.
Absolutely. A little expert advice can go a long way.
Exactly.
Now, I noticed that the source material briefly mentions tax deductions on home loans.
Yes.
It sounds like there's a whole other world of tax benefits related to home loans.
There is. We've just scratched the surface.
Okay.
The Income Tax Act actually has specific sections 2480C and 80EE that offer deductions for different parts of your home loan.
Wow.
Everything from the interest you pay
Okay.
to the principal you repay can potentially be deducted.
So it's not just about deductions on the income from the property,
Yeah.
but also on the loan itself.
On the loan itself.
That's amazing. I bet our listeners are super curious to hear more about these home loan deductions.
Right.
But we probably don't have time to unpack all of that today.
I agree. It's a topic that deserves its own deep dive.
Yeah.
Each of those sections has its own nuances and conditions,
Right.
but understanding them can lead to some serious tax savings.
Okay, noted. We'll have to add that to our list of future deep dives.
Yes.
So for now, though, let's wrap up our exploration of income from house property in India.
Okay.
We've covered a lot of ground today. What are some of the key takeaways you think our listeners should remember?
First off, always remember that house property for tax purposes includes the land attached to it,
Okay.
not just the building itself.
Right.
That's key for figuring out your property's value
Right.
and ultimately how much tax you might owe.
So it's the whole picture, not just the physical structure.
Exactly. The whole enchilada.
Got it. What else should our listeners keep in mind?
Well, knowing those key terms we talked about,
Yeah.
annual value, municipal value fair, rental value, standard rent, and actual rent received. Super important for navigating this whole process.
Yeah.
They're the foundation for calculating your taxable income from house property.
It's like learning a whole new language.
It is.
But once you understand the terminology, everything starts to click into place.
Exactly.
What about those deductions?
Yes, don't forget those two key deductions under Section 24.
Okay.
The flat 30% statutory deduction on your net annual value.
Right.
And the deduction for interest you've paid on your home loan.
Yeah.
Those can seriously reduce your taxable income.
And remember, those deductions come with some conditions, so it's worth doing your homework to see how they apply to your specific situation.
Definitely.
Another big takeaway, I think, is understanding the difference between the legal owner of a property
Yes.
and the deemed owner
Yes.
for tax purposes.
Exact.
Tax liability falls on whoever's actually benefiting financially from that property.
Right.
Even if their name isn't on the deed.
Exactly.
That's an important nuance, especially in cases like Mr. Babu's,
right.
where the legal owner isn't living in the property or getting that rental income.
Yes. Very important.
And let's not forget the potential for zero annual value.
Right.
If you're living in your own property as your primary residence, or if you're in a situation like Mr. Babu's,
Yeah.
where you have to live elsewhere,
Right.
the annual value of your property might be considered nil.
Right.
That means you might not have to pay tax on any potential rental income.
You got it.
But even in those cases, remember, you could still get those tax deductions
Yes.
on the interest you're paying for your home loan.
Absolutely you can.
That's a game changer.
It is.
We also uncovered some really clever tax-saving strategies that our listeners could explore.
Yeah.
Like taking out joint home loans, strategically deciding who owns the property,
Yes.
and making the most of that self-occupied property designation.
For sure.
With a little planning, you can really impact your overall tax liability.
Absolutely. Whether you're a seasoned homeowner or just starting out, understanding how income from house property is taxed in India is essential
Yes.
for making smart financial decisions.
This deep dive has given our listener a great foundation to build on.
It has.
But as always, this is just the beginning.
This is just the tip of the iceberg.
There's so much more to explore, especially when it comes to those home loan deductions.
So much more.
I think we know what our next deep dive should be about.
I think we do.
But before we go, I have one last thought-provoking question for our listeners.
Right.
Given all these tax implications,
Yeah.
how might owning multiple properties versus investing in other assets affect your long-term financial strategy?
That's a brilliant question.
I know, right?
There's no right or wrong answer.
Right.
It all depends on your personal circumstances, your financial goals, and your risk tolerance.
Of course.
But it's something worth thinking about carefully.
Food for thought.
Yes, definitely. Yeah. And as always, don't hesitate to reach out to like a qualified financial advisor.
Right.
You know, somebody who can actually help you create a tax plan that's tailored to your specific needs and goals.
Yeah, that's solid advice because as we've seen today, knowing the ins and outs of those tax laws and having a smart plan can really give you an edge in the world of real estate and personal finance. Thanks for joining us on this deep dive into income from house property in India.
Yes.
I hope you found it insightful. And remember, stay curious and keep those brains buzzing.
And one last thought for you to ponder.
Okay.
We talked about how you can strategically choose which property to designate as your self-occupied property.
Right.
But what if those rules changed?
Oh.
What if you could only claim one property as an SOP for your entire lifetime?
Wow.
How would that impact your long-term investment strategy?
That's a really interesting question.
Yeah.
It definitely throws a new wrench into the mix.
It does.
Something to think about for sure.
Yes.
Definitely. Well, on that note, we'll wrap up this deep dive until next time. Happy investing.